According to new data released just days ago, the median household income in Toronto sits at around $98,000 a year. The minimum income you need to qualify for a mortgage on an average priced home in that same city? $190,000. That's nearly double what most families actually earn. And it's not just Toronto. A new CMHC report published February 25, 2026, confirmed what a lot of Canadians have been quietly feeling for years. The affordability crisis has spread. It's now hitting Ottawa, Montreal, Halifax, cities that used to be the escape valve when Vancouver and Toronto got too expensive. So today, we're breaking down exactly why Canadian incomes have fallen so far behind what a 2026 mortgage actually costs, what this means for you, whether you're a homeowner, a renter, or someone trying to get into the market, and what the numbers say is coming next. Let's get into it.
Here's the basic problem in one sentence. Home prices exploded during the pandemic, mortgage rates tripled afterward, and wages never kept pace with either. According to a University of Ottawa analysis released this year, incomes in Canada have risen 76% since 2004. Sounds decent, right? Except the price of a new starter home at the lower end of the market, the kind a young family would actually buy, has jumped 265% over that same period. That's more than 3 times faster than wages grew. So we've had 20 years of slow, steady income growth colliding with 2 decades of home prices running in the opposite direction. Then the pandemic hit. The Bank of Canada dropped interest rates to a historic low of 0.25%. People rushed in, demand spiked. Home prices in cities like Toronto and Vancouver went parabolic. And then in 2022, inflation hit a 40-year high of 8.1%, and the Bank of Canada responded with the fastest rate hiking cycle in modern Canadian history, 10 consecutive rate hikes. Mortgage rates that sat at 1.5% or 2% in 2020 and 2021 suddenly became 5%, 6%, 7%. And the people who bought homes during that low-rate window or are renewing now are the ones feeling it hardest. The Bank of Canada's own research put it plainly. Even with rate cuts in 2024 and 2025, mortgage payments for the average Canadian are still significantly higher than they were before the pandemic. And that gap between what people earn and what a mortgage actually costs has never been wider.
Here's where it gets really concrete for a lot of Canadians. According to the Bank of Canada, roughly 60% of all outstanding mortgages in this country are set to renew in 2025 or 2026. That's about 1.5 million households who already renewed by the end of 2025, and another million more renewing right now through 2026. Most of these people locked in their 5-year fixed rates back in 2020 and 2021 at rates between 1.5% and 2.5%. When they renew today, they're looking at rates around 4% to 4.4%. That difference sounds small. The dollar impact is not. The Bank of Canada ran the numbers. Homeowners with 5-year fixed mortgages renewing in 2025 or 2026 are looking at average payment increases of 15 to 20% compared to what they were paying at the end of 2024. For a typical $500,000 mortgage, that's roughly $320 more per month, or about $3,800 more per year. RateHub.ca illustrated it this way. Someone who bought an average-priced home in 2020 and is renewing this summer could see their monthly payment jump by about $424. That's over $5,000 more per year coming out of the same household budget that's also dealing with higher grocery bills, higher insurance, and higher everything else. And for about 10% of variable rate fixed payment mortgage holders, the ones whose loans are resetting now, the increases could top 40%. A Royal LePage survey found that 57% of Canadians renewing this year expected their payment to go up. Of that group, 81% said the increase will put financial strain on their household. What are they doing about it? Most are cutting spending. 70% said they'd reduce or eliminate discretionary spending. A third said they'd cut back on saving and investing. 29% said travel was the first thing to go. This isn't panic selling, but it is a slow, quiet squeeze on household finances happening right across the country. If you want to stay on top of what's happening in Canada's housing market, we break this stuff down every single day. Hit subscribe so you never miss an update.
Now, let's get specific, because the income to mortgage gap looks very different depending on where you live. In Vancouver, the average home price is over $1.5 million for a detached property. That means you're required to put at least 20% down. That's $300,000 just to get in the door. Families there are on average $121,000 short of the income they'd need to qualify. Not slightly short, 6 figures short. In Toronto, the average home price sits near the $1 million mark. According to Nesto, the income required to qualify for that home ranges from about $162,000 to $190,000, depending on your down payment and rate. The median household income in Toronto, about $98,000. The gap is nearly $95,000. Even nationally, across all of Canada, Nesto's data shows the income needed to qualify for an average-priced home ranges between $119,000 and $140,000. The average national home price as of January 2026 was $652,941, according to CREA data. For context, the mortgage payment on a representative Canadian home as a percentage of income, what National Bank tracks as the MPPI, stood at 51.6% at the end of 2025. The long-term average since 2000 is 40.5%. We're still 11 percentage points above normal. So what does this mean for you specifically? If you're a homeowner renewing, this is the year to run your numbers early. Don't wait for the renewal letter to show up in the mail. Talk to a broker now. A few weeks of preparation can mean thousands of dollars in savings. If you're a renter wondering when to buy, the good news is that affordability has been improving in most cities, driven more by price drops than rate cuts. Prices fell 2.6% year over year nationally as of January, but affordability is still historically stretched. The decision to buy should be based on your financial position, not on timing the market. If you're a first-time buyer, the stress test remains a major hurdle. You qualify at your mortgage rate plus 2%, so even if you're getting a rate of 4.4%, the bank qualifies you at 6.4%. That stress test rate significantly reduces how much you can borrow, and it's by design.
The Bank of Canada held its policy rate at 2.25% in January 2026. The next rate announcement is March 12th. Economists are watching carefully because trade tensions with the U.S. have created enough uncertainty that the central bank has basically said the next move is hard to call. Fixed mortgage rates are tied to bond markets, not just the BOC's rate decisions. Right now, the best 5-year fixed rate available in Canada is around 3.69% to 3.79%. That's down from the highs, but still nowhere near 2020 levels. CMHC's Housing Market Outlook, published in January, projects that sales will increase in 2026, partly because some buyers who sat on the sidelines are starting to move. But the forecast still puts sales below the 10-year historical average, held back by what CMHC called ongoing affordability challenges for many households. The affordability crisis, according to the new CMHC Composite Index, released just days ago on February 25th, has officially spread beyond Toronto and Vancouver. Ottawa, Montreal, and Halifax are now showing near-historic stress levels. The agency pointed directly to 2022 and 2023 inflation, strong immigration, and rising non-housing costs as the drivers. And for renters, the CMHC's 2025 rental market report showed vacancies rising slightly to 3.1% nationally, but warned that the most affordable rental units remain extremely tight. Relief at the high end of the market is not being felt where it's needed most. Here's the bottom line. Canadian incomes have not kept pace with the cost of owning a home. The gap isn't new, it's been building for 20 years, but the pandemic and the rate cycle that followed made it worse faster than almost anyone predicted. Right now, roughly 1 million Canadian households are navigating a mortgage renewal that costs them hundreds more per month than it did 5 years ago. Families in Toronto are $95,000 short on income. Families in Vancouver are $121,000 short, and cities that used to offer relief are now joining the problem. The market is not crashing, the data doesn't show that, but it is squeezing, and for a lot of Canadians, that squeeze is very real right now. We'll keep tracking the numbers every single day. Hit subscribe, drop your questions in the comments, and we'll see you in the next one.